On June 10th, inflation came in at 4.2%. Payrolls had already doubled expectations, and the 10-year Treasury didn't flinch. That silence is the warning. What bond traders are pricing may be the one thing equity investors aren't prepared for. The May 2026 Consumer Price Index arrived exactly as predicted, 4.2% year over year. It was released by the Bureau of Labor Statistics on June 10, 2026. That figure matched the market consensus, but it remained stubbornly above the Federal Reserve's 2% target. For policymakers, the data offered no relief. Even when inflation meets expectations, a number this far above target preserves the case for a restrictive stance. The underlying message is persistence. Instead of an upside shock or a sudden acceleration, the print confirmed that elevated prices are proving difficult to dislodge. Core CPI at 2.9% also stayed well above the Fed's comfort zone. In this environment, the argument for immediate rate cuts grows weaker. The central bank's credibility depends on anchoring inflation expectations, not chasing market hopes for quick easing. For investors, the result is a policy backdrop that remains tight even as headline numbers fail to surprise. The bond market's warning is less about crisis and more about the durability of these above-target inflation dynamics. Hiring momentum in May 2026 delivered a clear surprise. The Bureau of Labor Statistics reported a gain of 172,000 non-farm payrolls, more than double the consensus forecast of around 85,000. Upward revisions to the prior month brought April's figure to 179,000, reinforcing the message that the labor market remains sturdy. Unemployment held steady at 4.3%, and average hourly earnings continued to grow at a 3.4% annual pace. These results point to an employment landscape that is resilient, not faltering. For the Federal Reserve, such strength removes immediate pressure to cut rates. When jobs growth consistently beats expectations, policymakers see less risk of a downturn and more reason to keep policy restrictive. The dual mandate, balancing price stability with maximum employment, still tilts toward caution. With both inflation and labor data showing persistence, the argument for a rapid policy pivot weakens. The macro backdrop is defined by durability, not distress. The 10-year Treasury yield opened at 4.53% on June 10th and barely budged after the latest inflation figures crossed the wires. Even as the market absorbed above-target consumer price index readings and robust payroll gains, the benchmark yield hovered in a narrow 4.53% to 4.54% range for the rest of the session. For bond traders, this stillness carried weight. The price action suggested that investors had already internalized the case for a higher-for-longer policy stance. There was no scramble to reprice risk, no surge in volatility, just a quiet, steady tape. In the language of the market, conviction sometimes reveals itself not through dramatic swings, but through the lack of movement when new data arrives. The muted reaction reinforced the message. Policy expectations remain anchored, and the risk premium for holding longer-dated treasuries is not about sudden shocks, but about the durability of current risks. For investors, muted price action can be its own signal, a sign that the bond market's caution is rooted in preparation, not surprise. Stocks and bonds are reading the same economic landscape through different lenses. Equity investors often look ahead, focusing on the potential for growth and the chance that policy will soon turn more supportive. In contrast, bond traders act as risk managers, prioritizing what could go wrong, whether that means persistent inflation, policy credibility, or the threat of macro uncertainty. This difference is not just about temperament. It shapes how each market prices the future. The current bond market is not bracing for disaster. Instead, it is embedding a premium for patience. Yields at the long end remain elevated because investors are demanding compensation for the risk that rates stay high for longer than consensus expects. This compensation, the term premium, reflects more than just projected Fed moves. It also incorporates expected real rates, inflation forecasts, and the uncertainty around both. In early summer 2026, models from the New York and San Francisco Fed estimate the term premium at roughly 40 to 70 basis points, a meaningful share of the 10-year yield. A hawkish policy backdrop through the spring reinforced this stance. While equity markets might rally on any hint of easing, bond traders are waiting for clear, sustained evidence of disinflation and a shift in central bank tone. Until then, the yield curve remains disciplined, and the warning from fixed income is not about crisis, but about delay. Investors tracking the bond market's warning should focus on 5 concrete signals. First, the upcoming Federal Reserve meeting stands as the key policy test. Any change in language or forward guidance will clarify whether the committee is prepared to pivot or remain cautious. Second, the updated dot plot will reveal the range of views inside the Federal Reserve. If the spread between hawkish and dovish projections widens, policy uncertainty and the term premium may persist. Third, the next set of consumer price index releases will test whether inflation is finally easing toward the Federal Reserve's target or if price pressures remain entrenched. Fourth, monthly jobs reports will show whether the labor market's resilience is starting to fade or if strong payroll growth continues to justify patience from policymakers. Finally, the 10-year Treasury yield remains the real-time verdict. If yields hold above 4.5%, the market is still pricing in a higher-for-longer regime. These indicators together provide a disciplined framework for portfolio positioning in a market defined by caution rather than crisis. With inflation still above target and robust job growth, the bond market signals patience, not panic. For investors, risk management, not rate cut optimism, remains the operative lens. That caution endures. Headlines tell you what happened. Signals tell you what happens next.